As you sip that hazelnut latte with a dusting of cinnamon, spare a thought for the coffee bean growers who helped to bring it to your lips. Prices for the choicest Arabica beans are now into a third year of declines, with little prospect of a fundamental reversal. While costs for labor, fuel, and fertilizer keep rising, producers from Kenya to Costa Rica are struggling to break even. As always, the industry itself is to blame. Coffee is a perennial crop subject to relatively low levels of demand growth, which meant that it sat out the big commodities rally of 2008. But in 2009 and 2010, a series of supply shocks centering on Colombia, the world's #2 exporter, drove prices steadily higher. That encouraged growers to plant more of a crop that takes 3 or 4 years to reach fruition. The big coffee buyers, meanwhile, started using cheaper Robusta beans in their blends. Recession-hit consumers in developed markets either did not notice or did not care. Consumers in emerging markets saw any kind of brew as a hallmark of status. The result is that new supplies of washed Arabica beans are coming into a market already saturated with them. The benchmark coffee contract, down 60% from its May 2011 peak, ranks as the world's worst performing commodity this year. It was the worst performer last year too. A short-term spike is possible, given fears over an outbreak of fungus in Central America. And as Macquarie notes, the government of Brazil, the world's largest producer, could expand its subsidy program to push prices higher. But against that, the plunge in emerging market currencies against the US dollar is encouraging growers to keep yields higher than they really need to be. The machine is still out of order. Ben McClenahan, Financial Times.